We're going to talk about sources of financing and primarily the activities required that entrepreneurs, small business owners need to take to get a loan. Before I start, I want to kind of make the disclaimer. It's not really an accident that I am putting this in the middle of the semester material rather than at the beginning, where you might think, okay, one of the first things I want to do as a small business owner is get that financing. I mean, it is true that it costs money to start up, but it is very difficult, contrary to what a lot of students believe, to go and secure that loan or secure that venture capital before you have a track record of sales. And so, because this is a small business class and we're not really focused on the startup process front and center, but more on running a small business, and because it's more realistic to think about getting a loan once the business is up and going, I'm putting it here. Now, I want to talk primarily in this lecture about getting a loan. On a scale of 1 to 10, with 1 being you walk in the door and just ask for it, and a 10 being, win the lottery. How difficult is it to get a loan? Well, that depends on who you are and what you know and what you can do. It actually is pretty difficult. It's more difficult than a lot of entrepreneurs suspect that it is. Maybe it's like a 7 or 8 on that scale. My goal on this lecture is to take you, though, from like a 7 or 8 to a 4 or 5, meaning much more easy to get that loan if you're armed with the right knowledge. And so I'm going to try to give you the background. Perhaps the biggest obstacle for a young small business owner, if most of you guys are in your 20s, and if you try to start a small business right after college or in the next 5 years, your youth is actually going to be something that works against you a little bit. Age and a lack of personal experience certainly work against the individual, because banks especially are looking for some kind of track record. Not only are they investing in a business and a business idea, they're investing in a person, and actually they take that extremely serious. Maybe the most critical component of all is evaluating the person, and it's harder to do with less of a track record. Being youthful doesn't really help you with that. All right, so in this chapter we are going to be talking about different sources of financing, and this slide shows the most common sources of financing. So when you initially start a small business, most owners have to rely, the ones at the top tend to be more common. I don't think this is an exact ranking because I've looked at some rankings and it doesn't quite match up with this. But most small business owners do rely on a lot of personal savings, and usually seeking financing help from family and friends. And that may be either in the source of a loan or in the source of an investor. Maybe the friend will pitch in and be a business partner, or maybe they will be a silent investor. If these sources are not adequate, that's when the owner tends to look towards more formal channels. Some sources of financing, such as the bank, business suppliers, asset-based lenders, and the government, essentially provide only debt capital. That's money that you have to pay back. That's the good part of that, is that you retain the ownership of the company, right? If you issue stock, then somebody else becomes part owner of your company, and all future profits are going to be cut by that. But if you rely on equity, then it's you. But the bad part is, of course, you have to repay that loan. I do want to make the point that venture capital is actually pretty rare, and even equity investments from outsiders, from people you don't know, less than 5% of small businesses get loans from that source. So if that's kind of always been in your mind as a plan, it's doable depending on what your business idea is. But just kind of know that that's a tough road, and you have to have an idea that is very winning, maybe somewhat original, and that you really have to, you've got a lot of competition, right, for that venture capital. Before I go on, I do want to talk about getting money from friends and family, that second line there. Using friends and family does put personal relationships at risk. For that reason, you might think of it as a high-risk source of money, especially if not done right. I think it's smart to seek advice from an experienced entrepreneur who has gone that route before you decide to do it. It's a big plunge that a lot of people take really easily, right? They rapidly go that route without really thinking through the consequences, because loans from friends and family can be obtained so much more easily and so much more quickly. You don't have to, a lot of times, write a business plan to get that money. I think the first rule is that you should accept money from friends and family if and only if that person is not really going to be hurt in terms of their well-being and their current lifestyle if the business flops, right? If you're unable to repay the loan, or if the business, doesn't make it and that investment is lost. There are lots of entrepreneurs that tell stories about damaged or lost relationships with friends and family because of bad business ideas or business money, and I think that's really a shame. I think that that's something that you'll always regret, and when you come to the end of your life, hopefully not too soon, that'll be something that you'll look back and say, hey, that was not worth it, losing relationships over. To minimize the chance of damaging important personal relationships, it's important to repay loans from them as soon as possible. In addition, any agreement, best practice is to definitely put that in writing. It's best to clarify expectations up front rather than to be disappointed or angry later. Now, one source of financing that is not listed on this slide that's really, really common is credit card debt. It's been estimated that about half of new business owners finance their new business with a credit card, and the interest rate on that is super high. A lot of times the interest rate exceeds 20%. And if you don't know, if you're planning on getting in small business, you probably should know this by now. You should understand how interest works. Interest is the percentage that you don't just pay back once, you pay it back every year. At one point in my life when I was an undergrad and I heard about interest, a 25% interest rate, that means if I borrow $1,000, I pay back $1,250. Well, that's true if I pay it back within a year, right? But if you borrow a big amount and it takes you years and years to pay that back, you're paying that $2,500 every single year. That interest is what you pay for the cost of using the money. So for instance, when you go to buy a house and you look at the way that the payments are broken down in terms of the interest and the principal, what you'll see is that for the first 10 years or so of owning the house, you'll actually end up paying more interest with each of your house payments than the part that you're paying down on the loan, the principal. So credit cards can be hugely expensive. You can definitely wind up paying a lot more in interest than you ever did in principal, and that's not good return on investment. If you think about the average return on assets for a small business being maybe 10%, and the debt that you use to finance it, having where you're paying 50% or 100% to use that money over time, that is, that's not a way to be profitable. If you can pay it back in a short amount of time, though, if you're really sure of future sales, that's when it becomes viable. So that's why some entrepreneurs do use credit cards. I'm not going to sit here and tell you never use credit cards to finance your small business. It's been done too many times successfully for me to say that to you. At times, credit cards are the only route that small business owners have available to them. And they also have the advantage of speed and ease of use, right? It's really easy to pull out that card and swipe it. So in practice, credit cards are a significant source of financing for a lot of small business owners. But the goal is to use credit cards only as a method of payment and not as a source of credit very quickly. In making a loan decision, bankers give very strong consideration to what they call the 5 C's of credit. The borrower's character is at the center of that, but things that impact the banker's read on that are the other 4 C's. So your capacity to repay the loan, in other words, the ability of the business idea that you've come up with to repay the loan. The capital that you've invested in the business, obviously they are going to be more impressed, more likely to depart with some money if you've invested a lot of your own money in the business. Your collateral to secure the loan. Do you have something that the bank can come in and take if the business goes belly up? And then they're also looking at industry and economic conditions, which I guess is, very different than the borrower's character, but the stringency to which they look at your character is going to be amplified if industry and economic conditions are not favorable. But at the center of all of this is the borrower's character. There is a saying among people that finance businesses that they would rather have an A individual with a B business idea rather than vice versa, a B individual with an A idea. And for that reason, there's a huge amount of scrutiny on your character, your ability. What all is involved in that? Well, a lot of things are involved in that. Your background and experiences there. Personal references are important. Obviously, your history of credit is important. There's just lots of things, but a lot of it is the competence in which you explain yourself. And so they're not just like trying to read whether you've got this good idea or not. They're also trying to get a read on whether you can pull it off. I will say that having an entrepreneurship major or minor is actually beneficial right here. Because what happens is, as you've kind of seen as you go through the E-Myth Revisited, is that a lot of people start businesses and they have the technical expertise, right? They can do the thing that the business is centered around. But do they have the business acumen and business skills? Well, if you've taken some business classes in college, or if you've even gone the extra step to get a major or minor that reflects some degree of critical learning at a pretty high level in business disciplines, then that really reflects well on you, and they're going to take that into account. So that in and of itself increases your likelihood of getting a loan. I think that a valuable practice when you go in to get a loan is the ability to put yourself in the seat, have the same perspective as the person that you're trying to get the financing from. So this goes for venture capitalists, it certainly goes for banks, any kind of outside investment. They're trying to ask themselves these questions, and you want to be the person that answers them in an affirmative way where they feel confident in you and your business idea. So first and foremost, the banker or person that's going to give you the venture capital, the investment, is asking themselves, do you have a strong character and reasonable ability? So they're assessing whether you can pull this off. Second, they want to know what's the purpose of the loan, and for that purpose, does the amount of the loan make sense? A loan or investment may be too small to even be worth the bank's time to do all the follow-up and paperwork. It also may be in an industry where the loan officer has no experience and does not understand that industry very well. But the main thing here is to focus on loans that are the right size, right? It's like your Goldilocks, right? You don't want the loan to be too big. You don't want the loan to be too small. You want the request to come in the right ballpark. If you ask for too little money, bankers who look at loan requests all day and look at business finances all day long are going to quickly see that you haven't asked for enough money. And that doesn't look great for you because it shows that you don't have a really good understanding of how much financial commitment that it takes. And so it reflects a little bit poorly on your character. In fact, there are a lot of instances where people come in and ask for a loan that's too small. This is obviously the good scenario. And the banker comes back and says, actually, you need more. We're going to give you, 50% more than what you asked because we really, we kind of believe in you and your business idea, but this is the commitment that we're seeing. That's a great scenario. Really, you want to come in with a number that very much more closely approximates what you actually need. By the same token, if you go in and ask for too much, the banker is going to say, okay, why are they trying to overfinance their business? What's going on here? And that really reflects badly on you. It makes you seem, A, you're not serious and you don't understand what's required in analyzing your business financial needs, or B, you may even look a little shady, like, the banker's going to think, well, what are they going to do with all this money? So what you need to have is an itemized timetable of what money you need, when you need that money, and the exact amount, what exactly you're going to be paying for with the money, right? So if you come in and you just have some pie in the sky, I really think I need $40,000 to get my business up and going because, that just kind of makes sense to me. It seems like the right amount. That doesn't look good. You want to have it in very fine detail what you're going to spend the money for. What the banker may say, once you need to have a couple of extra lines there, though. You need to have enough money for incidentals, right? Things that you don't foresee, and it's fine to bake that in. And then it's also okay to have a line there for some additional cash on hand for operating expenses, and that's kind of like unforeseen. But it's okay to itemize those two things differently when you come in and ask for the loan. And you want to be conservative with each of those, but they are, important things to include in the request. Now let me backtrack a little bit here. There are times when you will come in and just request a loan for a certain thing. And actually that's actually pretty common because if you are going to try to buy something that has a lot of value that the bank could come in and just take from you if you fail to repay it, you're much more likely to get a loan for that kind of item, right? So, you get that kind of thing financed because there's the collateral, right? The bank, you didn't make your payment, the bank comes in and seizes the company van and then they can sell it for what they, for part of at least what you owe them. Third, is the transaction and the relationship good for both the customer and the bank investor? There needs to be some degree of trust there, a good mutual working relationship. Bankers can actually be relied on for some expertise. Those that are always, that it's their job to finance small businesses. They may have some skill and expertise in managing money and managing small businesses that you can go to them for aid. So they're looking for good rapport, good relationship. But the other aspect of this is that, I mentioned it a second ago, some banks specialize in certain kinds of businesses. And so before you go to a particular bank looking for a loan, you need to do your research and see whether they have some knowledge of your industry. Okay, fourth thing they're looking for. Does the loan have a certain primary source of repayment like expected sales? And obviously it should, but what you really want to have, and it's beyond the scope of this course, is a pro forma cash flow statement where you're showing the loan repayment coming out of the sales and never being in negative cash. A lot of times what bankers, outside investors look for before anything else is your cash flow statement, and if you've got a pro forma cash flow statement, you're really ahead of the game. Software like QuickBooks can help you generate those pro forma cash flow statements, and honestly, if you go into a bank and you have shown the ability to generate those, one, it puts their mind at ease in terms of how you're going to repay it, especially if you can justify those sales. It also makes you look more trustworthy as an individual. A, that you care about this. B, that you've got the ability to pull off a pro forma cash flow statement and understand what it is and the numbers there. Because it's not just simple to pull off. And so you're ahead of 90% of people that walk in there if you have that pro forma cash flow statement generated. I would not go into a bank without having that. Okay, they also want to know what is the collateral. Basically, do you have a house or a truck or a diamond ring or something like that that they can take to, if you aren't able to pay off your loan. Most banks are going to require collateral. Now, a lot of people, a lot of students anyway, think they're under the impression that if I just do an LLC, limited liability corporation, that I'm protected from all of that. And LLCs are really easy to get, right? It's easy to send in the documentation to the state of Tennessee and get an LLC going. It really is not going to benefit you that much in terms of the bank's perspective. They are still going to make you sign a document that says, this is the collateral for the loan. And they're perfectly allowed to do that. And if you don't want to do that, they can say, fine, you're not required to do that, but I'm not going to give you a loan. All right, so the LLC's value is pretty limited there. All right, finally, for a loan, can it be priced profitably for both yourself and for the bank? It's interesting, your and the bank's interests are pretty well aligned. The banker really wants you to be successful. It's not an adversarial relationship where you're trying to outsmart them. You're trying to give them as much information as you can, and you want them to help you be successful. They want you to be successful because A, their loan is being repaid at the way that they said it would. It makes the loan officer or the investor look good that made this decision. But B, they're hoping that you'll come back to them for repeated business once your business grows and there are increasing financial needs for growth. And so really your interests are perfectly aligned. You're on the same team. You're not trying to pull the wool over their eyes. You're not trying to make yourself look, you really don't want to make yourself try to, look better in their eyes than you really are, because A, they look at this stuff all the time. They evaluate small businesses and entrepreneurs all the time, and they're going to see right through it. B, they can't help you as much when you do that. And so it's important to kind of understand, yeah, these are the things they care about. I need to explain these things. But once we clear these hurdles, we're on the same team and we're pulling together as one unit. A well-prepared request is absolutely necessary. It reflects your ability to capture the company's history and future in writing. And it suggests that you've given a lot of thought and that you're credible. Again, it goes back to that personal character, that personal credibility. As part of the presentation, the banker or the investor is going to want to know the following things. One, how much money is needed. I already talked about this, but you've got to have that number pegged and you want to do it as accurately as possible. All right. Two, what is the venture going to do with the money? Itemize where the money's going to be spent. Three, when is the money needed? It looks good and shows competence if you come in and don't just ask for a lump sum up front, but say, okay, we need this amount now. We need this amount in 6 months, and we need this amount within the next 3 years. And these are the ways we're going to spend that money over time. Or even better, you may not need any money now, but you say, hey, we're looking ahead and we see that in early 2021, we're going to need X amount of money. All right, you need to be able to prove when and how the money will be able to be paid back. We talked about that, but your source of income. This one says up to 3 years of historical financial statements. I actually talked to a banker at Regions that does small business loans. He said 6 months to a year was the minimum for them. It depends on the bank, but a lot of them are going to require that full 3 years of historical financial statements. You also want, already mentioned it, pro forma financial statements, especially a pro forma cash flow statement. But if you can do a pro forma balance sheet or pro forma income statement to show the growth of the business in terms of scale and the profitability of the business, that looks great too. You also need to bring in personal financial statements to show your net worth, your estimated income, your credit score, etc. They're probably going to do the research and get your credit score. But a good request is going to include all of those things. So in order to really prepare and maximize your chances of success, you want to prepare all of those things. You don't want to just waltz in off the street. Admittedly, some of these things are a little bit hard. The historical financial statements, require time in the industry. The pro forma financial statements require some accounting skill, and you may want to have an accountant work with you to generate those if you can't do it yourself with QuickBooks. But once you go in, once you generate that with the accountant, you want to be able to go in and fluently talk about it, right? So they may generate it for you, but you need to understand it frontwards and backwards once they do. Have them explain it to you so that you completely understand why it looks the way that it looks. Okay, I already spoke about interest earlier and how interest can be a really expensive part of money when I talked about credit cards. Bank loans aren't as expensive as, as credit cards, obviously, but there's still a significant amount of the repayment that goes into interest. And over a long-term loan, you really may end up paying more interest than the actual payment, the actual principal. So interest is the cost of borrowing money. The interest rate is the percentage of the entire loan that you will have to pay back to the bank each year. It's the amount of the remaining loan. So, right, you pay down some principal. You don't have to pay interest on the principal that you've already paid down. But let's say you got a $50,000 loan, and at the end of a year, you're down to $40,000. Well, in year 2, you have to start paying money on the $40,000, paying interest on the $40,000 that remains on the loan. So the interest rate is the percentage of the entire loan you have to pay back to the bank each year for the benefit of using its money. There are 2 main types of interest rates. Most people will choose to go the fixed interest rate way. Just because, interest rates have been low for a long time, and for that reason, a lot of bankers and a lot of financial advisors say lock it in while it's low. Well, how do you may come to me and say, well, what do you mean it's low? If it's been low for a long time, maybe low is different now than it used to be. Well, that's possible, but in raw numbers, if you've got interest rates in the 5% range and you don't lock that in, the chances that it can go much, much lower than 5% are low. There's not a lot of room there for the interest rate to get a lot lower. It may be able to go down to 3% or something for a business loan, although that would be really low interest. But it can go up super high, right? It can go up to 15, 20%. There was double-digit inflation during large chunks of the 70s and 80s, which may seem like ancient history now, but because we know that this can happen very easily, it's probably makes more sense a lot of times to lock in a low fixed interest rate. The floating interest rates will be whatever the overall interest rate is for the country, that's what I pay. And so if interest goes up, if the cost of borrowing money goes way up under that scenario, well, I have to repay all of that. When you go in to borrow money, there is a very large likelihood that you will have to sign something called a loan covenant, and those are bank-imposed restrictions on a borrower. On this slide, I list some examples of loan covenants. You may have to provide financial statements regularly to the bank as part of your admission ticket for using their money. And if you don't do that, they can call all or part of your loan, or there may be penalties. There may be restrictions on what you can use the loan for. They may limit how much you can pay yourself, salary limits. There may be equity requirements. That means that more than half of, in some cases, it could mean different things, but it could be that more than half of financing has to come from equity. In other words, the bank or loan money can't pay for more than half of your business. So, and then there may be some personal guarantees by the borrower in terms of your collateral. So those are all examples of things that a loan covenant might require. Okay, I don't want to completely ignore the equity side of it. Remember that it is a small percentage of companies, about 5%, that get outside equity investment. That is, equity investment from people they don't know. So somebody that invests in the company, you don't have to pay back investment from somebody we don't know. The largest form of that in the country, or at least the most common, I won't say the biggest chunk of money, but the most common source of that for small businesses is what is known as business angels. The amounts that they invest in small businesses each year range from $30 to $40 billion, so certainly not a trivial amount, and they are there. This is the most likely way you're going to get outside loan money. Business angels they are usually looking for a small business with maybe less than 20 employees. A lot of times they invest locally, and they tend to invest in the types of industries where they have a lot of background and experience. Typically, business angels are older individuals that have kind of made their money, and now they want a chance to shepherd and kind of go through the process of bringing a young upstart company into being. So they're kind of looking for two things. They're looking for the ability to be involved and engaged and to get that fulfillment of helping someone else. So they like the life and they want to kind of be involved vicariously. And they also want to invest in something that is young and coming up so that the potential for profit there can be quite large for them, right? It's if you invest in a chunk of money early in a business, you've got a big ownership claim in that business, and therefore the profits are going to be larger if the business makes it. So other than the money, they're also contributing the know-how, right? They want to give you their expertise. And for that reason, they can be very demanding, right? They want you to live up to the standard that they believe they've set, and they have been successful. So, they tend to really have an exacting standard, and they want to be heavily involved in the business. They believe they know and probably do know what should be done. So in order to deal with business angels, you need to understand their motivation. They want to give back. They want to take risks. You want to enable them to live vicariously because they enjoy helping. You want business angels that sign up other people, other angels, right? Because the angel knows those people. And also you want business angels with good connections, right? That can bring in connections that may help your business, whether they're in the government, whether they are in legal or accounting, and can help shepherd and grow your business. Those connections, that social capital that you may not have, that the business angel has, can be super valuable. So you want to be nice to your business angel if you're fortunate enough to get one. Okay, last slide. Formal venture capitalists. Less than 1% of companies get these formal venture capitalists. Here's how formal venture capitalists work. There is all of this money that people have in their retirement, and people want to diversify their portfolio, right? And so, every year a chunk of my income gets saved to my retirement, and it goes into a portfolio, and a lot of it goes into really safe stuff, and some of it goes into moderate stuff like the stock market. And a sliver of what I've got, maybe a couple $100s a year, goes into a venture capital fund. And these are individuals that are looking for long shots that could potentially be like grand slams. So they're looking for, and they invest in a lot of potential companies, but companies that have the potential to really revolutionize things, right? They're looking for the next Amazon or the next Facebook, or just any kind of company that's going to be a publicly traded household name. And they're investing in a lot of these companies with the knowledge that 9 out of 10 of them are going to fail, but that the 1 out of 10 that doesn't fail is going to be such a huge success that it's hopefully going to generate great returns for that venture capital firm. So these formal venture capitalists are the people who run those portfolios, right? Me and all the state of Tennessee employees sending their money to the same place, and there's a venture capital firm that it's their job to invest in promising high potential startups. All right, so they're looking for high profit potential, high rate of return on those investments. Generally, to get venture capital from a venture capitalist, you need to have a novel business idea or be involved in some kind of new technology. There needs to be something that really grabs their attention and they say, whoa, this is different than what else is out there and really has the potential to shake things up. A lot of the same principles apply. It's just that we've talked about with the loans and with the business angels. It's just that the threshold becomes ever so much higher with these formal venture capitalists. Okay, so that's basically it. Those are the basics of what I want you to know about acquiring financing. I want you to, and I will be evaluating this, apply some of these principles as you come back to me for venture capital in the third quarter, right? So first quarter is over by the time you watch this video, in all probability, unless you watch it early. But I want you to, I'll be looking for some of the things. I want you to understand that I'm looking for the 5 C's. Well, not exactly the 5 C's, since I am an equity investor and not a loan investor, so I'm not looking for your ability to repay the loan. But I am looking at your character. I'm looking at your understanding. I'm looking at for your understanding of how the money is going to be used. So apply the principles as you are making this presentation.